Let's get straight to it. Today we're diving into a question that's on a lot of people's minds. How can you make your savings work harder for you? And is it really possible to turn a lump sum into a steady, reliable stream of weekly income? Have you ever looked at your savings and wondered if your money could do more than just sit there gathering a tiny bit of interest? Maybe you've thought, isn't there a smarter way to use what I've worked so hard to save? You're definitely not alone in that thought. Imagine this, you have a lump sum, let's say £10,000, just sitting in your account. Now picture that same money being transformed into a stream of cash that lands in your account every single week, almost like getting a paycheck, but without having to clock in or out. This isn't about chasing get-rich-quick schemes or taking wild, sleepless night risks. Instead, it's about using a strategic, thoughtful approach to investing. One that's designed to give you regular, predictable income so you can plan your life with more confidence. Picture waking up on Monday morning and seeing extra cash in your account. Enough to cover your weekly food shop, fill up your car, or treat yourself to that daily coffee. All of this without having to do any extra work. That's the power of passive income. We're talking about passive income, where your money is out there working for you, earning more even while you sleep or spend time with your family. Today we'll explore how a specific investment, weekly dividend ETFs, can help you turn your savings into a weekly paycheck. These are special funds that pay out dividends every week, giving you a steady flow of income. We'll break down exactly how these investments work, what kind of rewards you might expect, and what risks you need to be aware of. And don't worry, we'll keep it all in plain English so you can follow along even if you're new to investing. My goal? To give you the information and confidence you need to understand your options so you can make smart choices for your financial future. So, can you really turn £10,000 into weekly income? Is it realistic, and what does it actually look like in practice? Let's find out together. First, let's see why that £10,000 figure matters and how it can be the starting point for building your own stream of weekly income. Passive income is money you earn without working for it every day. Think rent, royalties, or dividends. Your job pays you for your time, passive income pays you for owning assets. Investing £10,000 is a tipping point. It's enough to generate weekly payouts that actually make a difference. With less, the income is barely noticeable. With £10,000, it can cover real expenses. It's like planting a tree that's big enough to bear fruit you can actually use. This amount also allows for diversification and helps absorb investing costs. £10,000 is a realistic, achievable goal for many. And it's the key to unlocking meaningful passive income. Now, let's see how to put that money to work. Imagine you have £10,000 and you want to turn it into a steady stream of weekly income. Is it possible? That's where weekly dividend ETFs come in. A new way for investors to potentially earn money every single week rather than waiting for monthly or quarterly payouts. These funds are designed to provide frequent, reliable cash flow, making them especially appealing for anyone looking to supplement their income or cover regular expenses. An ETF, or exchange-traded fund, is essentially a basket of different investments, like stocks, bonds, or other assets, that you can buy and sell on the stock market just like a regular share. This means you get instant diversification and you can trade them easily throughout the day. Some ETFs are specifically engineered to pay out high levels of income, and they do it every single week. That means you could see money landing in your account far more frequently than with traditional investments. Let's break down 3 of the most talked about weekly dividend ETFs on the market right now: YMAX, ULTY, and QQQY. Each one has its own unique approach and potential rewards. YMAX is designed to maximize income by holding a mix of high-yield ETFs. With a hypothetical annual yield of 30%, that could translate to about £57 a week from a £10,000 investment. It's a popular choice for those who want consistent high payouts. ULTY, on the other hand, focuses on the giants of the tech world, companies like Apple, Microsoft, and Google. It aims for a 25% yield, which works out to roughly £48 a week. This ETF is for those who want exposure to big tech while still earning regular income. QQQY takes a different approach by using a strategy based on the Nasdaq 100 index. Its potential yield is even higher, up to 50%, which could mean an eye-popping £96 a week. But remember, higher yields often come with higher risks. So how do these ETFs generate such high income? They use a strategy called selling options. By selling options contracts, they collect premiums from other investors and then pay out those premiums to you as dividends. It's a clever way to turn market volatility into regular cash flow. But it's important to understand that high yields come with higher risks. The payouts can fluctuate from week to week, and your original investment, your capital, is not guaranteed. If the market takes a downturn, both your income and your investment value could drop. The value of your investment can fall, and the income you receive isn't fixed. These funds are not a guaranteed paycheck, so it's crucial to be aware of the potential ups and downs. In the next section, we'll dig deeper into each ETF's unique risks and rewards, so you can decide which, if any, might fit your financial goals and risk tolerance. For now, just remember, £57, £48, or even £96 a week is the kind of income power we're talking about with these ETFs. It's a way to potentially turn your savings into a steady weekly cash flow. But how do these funds actually work under the hood? Let's start by taking a closer look at YMAX and see what makes it tick. YMAX is a fund of funds. It holds a basket of other YieldMax ETFs, giving you instant diversification. If one stock underperforms, others can pick up the slack, smoothing out your weekly income. With a 30% yield, £10,000 could pay you about £57 a week. But remember, high yield isn't guaranteed. Income can drop and your capital can shrink over time due to NAV decay. YMAX is for those who want high income with less hassle and more diversification. You're trading the chance for the highest single stock return for a smoother, more stable ride. The share price may not grow and could decline. YMAX is an income tool, not a growth engine. Next, let's look at ULTY. ULTY targets the biggest tech names, Apple, Microsoft, Google, Amazon, using their volatility to generate weekly income. It's a focused bet on tech, aiming for a 25% yield, about £48 a week from £10,000. The upside, you're tapping into the world's most dynamic companies for regular cash flow. The downside, less diversification. If tech stumbles, so does your income. Like YMAX, ULTY's share price may not grow and could fall. ULTY suits investors who believe in tech's future and want income now, not just long-term growth. You're accepting sector-specific risk for potentially higher weekly payouts. Now let's see what happens when you chase even bigger yields. QQY is the most aggressive of the three, using a daily options strategy on the Nasdaq 100. It sells put options that expire the same day, collecting small premiums that add up to big weekly dividends. The headline, a potential 50% yield, £96 a week from £10,000. But the risk is huge. If the market crashes, losses can be swift and severe. QQQY is like picking up pennies in front of a steamroller. Great until it isn't. Your capital is at serious risk and income can vanish in a downturn. QQQY is only for the most risk-tolerant investors chasing maximum cash flow. It's not about growth, just high volatile income. Handle with care. Every week you have a choice with your income. You could simply spend it on everyday expenses, groceries, bills, or a night out with friends, or you could take a smarter approach and reinvest that money, setting yourself up to supercharge your returns over time. Reinvesting means using each week's payout to buy more ETF shares, which allows your investment to grow not just from your original money, but from the new money it earns each week. It's like a snowball rolling down a hill. With every week, your investment gets a little bigger, and that bigger amount earns even more the next time around. This cycle repeats, and your returns start to accelerate, creating a powerful compounding effect. Over months and years, this compounding effect doesn't just add up, it multiplies, turning small, regular investments into significant wealth. With weekly payouts, you're not just waiting for your money to grow, you're actively fueling its growth 52 times a year. That's 52 opportunities every year for your money to work harder for you, compounding much faster than with quarterly or annual dividends. The difference in speed can be dramatic. Weekly compounding can help you reach your goals sooner and with less effort. Of course, patience and discipline are key. Sticking to your reinvestment plan, even when it's tempting to spend, is what builds real wealth over time. By reinvesting now, you're planting seeds for a much larger pot in the future, one that can support your dreams and financial security. This is how you transform a simple income stream into a powerful wealth engine working for you around the clock. Every week you face a choice: spend your income now or reinvest it for a brighter future. The path you choose today will shape your financial future for years to come. Weekly compounding is a true game changer for long-term investors, giving you an edge that can make all the difference. So, let's take a closer look at what this growing income could actually cover in your life, and how it can help you achieve your biggest goals. What does £48, £57 or £96 a week really mean? £48 a week from ULTY is nearly £200 a month, enough to cover council tax, phone bills or broadband. £57 a week from YMAX, that's your weekly grocery shop or a savings boost for your kids or mortgage. £96 a week from QQQY, that's over £400 a month, potentially covering rent, a big chunk of your mortgage or your entire fund budget. Even modest passive income creates breathing room and reduces financial stress. It frees up your salary for other goals, holidays, debt repayment, or investing more. The psychological relief of having key expenses covered by your investments is huge. This is how passive income can change your day-to-day life. So can £10,000 become a weekly paycheck? Yes, with the right strategy and risk tolerance. YMAX offers diversification and stability, about £57 a week. ULTY focuses on tech for £48 a week with more risk. QQQY chases the highest yield, so £96 a week, but with serious risk to your capital. There's no one-size-fits-all answer. The best choice depends on your goals and risk appetite. This isn't financial advice, it's education. Do your own research, read the fine print, and talk to a professional if you're unsure. The world of investing now offers tools for regular income, not just long-term growth. Your money can work for you 52 times a year. Whether you spend or reinvest, the first step is deciding to act. The tools are out there. The choice is yours.